Welcome to this explainer. Okay, so today we're tackling what is frankly the ultimate test of commercial judgment, the ACCA Advanced Financial Management Exam. If you've ever stared at a massive 3-page advanced investment appraisal question and just felt this wave of absolute panic wash over you, well, you're definitely in the right place. We're going to break down these massively complex scenarios into a manageable, real-world project lifecycle. Think of this as your definitive blueprint for building a rock-solid, exam-passing investment case. We're going to approach this exactly as a CFO would in the real world.
Here's our roadmap for today. We'll quickly cover the overall AFM lifecycle, then dive into adjusted present value, tackle ungearing and regearing beta, look at international investment decisions, and finally wrap it all up with your final AFM exam strategy.
All right, part 1, the AFM lifecycle.
So, think about the huge leap you are making here. Back in your basic financial management studies, an investment decision might have meant, deciding whether to buy a single new machine for a local factory. The variables were pretty simple. But in AFM, the A stands for advanced, and your mindset literally has to match that. You are stepping into the shoes of a financial leader evaluating a massive, sprawling corporate project. That means we're no longer just looking at a simple net present value calculation. No way. Now you have to deal with complex financing side effects, the strategic flexibility of real options, like having the choice to abandon or expand halfway through, and of course, the severe, unpredictable risks of international investment. It's really all about taking that crucial next step up from pure math to true commercial judgment.
Moving right along to Section 2, Adjusted Present Value, or APV.
Now, the real magic of adjusted present value is how it allows us to strip a highly complicated project down to its absolute bare-bones all-equity base. Imagine we are looking purely at the operational success of a brand new factory. The fundamental question is, does it actually make money on its own merit? We want to answer that core business question before we even begin to worry about how the bank is going to finance it. APV explicitly separates that core operating net present value from the financing side effects, things like tax shields and issue costs. This gives a CFO crystal clarity on where the actual value is genuinely coming from. Okay, please don't let the dense formulas intimidate you here. If you just follow this exact step-by-step flow, evaluating APV becomes a super routine process. First up, you calculate your base case NPV by assuming the project is entirely equity financed. This means you must discount the project cash flows using the ungeared cost of equity. Then, you calculate the present value of the tax shield on your debt. Because interest is tax deductible, you simply multiply the annual interest by the tax rate and discount it at the cost of debt. Next, deduct any issue costs as a cash outflow right at the start in year 0. Why? Because, well, you got to pay those investment bankers their fees before the project even gets off the ground. Finally, add the present value of any subsidized loan benefits you might be lucky enough to get from a government.
If you take absolutely nothing else away about APV today, burn this formula into your brain. It's your ultimate survival tip. APV equals base NPV plus the present value of the tax shield minus issue costs plus the present value of the subsidy. Whenever the examiner hits you with a massive scenario involving subsidized loans and complex multi-layered debt, just write this exact line at the very top of your exam page. It is your anchor. It will literally guide you through the chaos, ensuring you don't miss a single crucial component of the calculation.
Which brings us to Section 3, Ungearing and Regearing Beta.
So, with our base project established, we now need to adjust for the specific risk of the industry to find our discount rate. But here's the million-dollar question. How do we actually remove the effect of financial leverage to find the pure risk of an asset? This is the exact trap so many students fall into when trying to evaluate a new project's true risk by looking at a quoted proxy company in the same industry. Think of evaluating a proxy company's equity beta like timing a sprinter who happens to be wearing a 50-pound backpack. The backpack is their debt. You can't simply take their sprint time and expect your own runner to match it, right? Because their equity beta is completely contaminated by their specific heavy financial leverage.
The fix for this lies in the asset beta. By finding the asset beta, we are effectively taking that heavy backpack off our runner. We are stripping away the proxy company's financial risk entirely, leaving us with a totally clean slate. The asset beta represents the pure underlying operational risk of the industry itself, 100% separated from how the business is funded. Once we have that clean, uncluttered asset beta, we perform the regearing step. And it follows a highly logical sequence. First, identify the quoted company in the same industry. Ungear their equity beta to find that pure asset beta. Next, we are going to take that pure operational risk and effectively dress it up in our own project-specific target capital structure. We re-gear it to reflect our planned levels of debt and equity. That mathematically outputs our project-specific equity beta. And only then can we confidently plug that newly tailored equity beta into CAPM, the capital asset pricing model, to find our precise cost of equity for the discount rate.
Seriously, memorize this sequence. Ungear industry beta to find the asset beta, then re-gear with a project's gearing to find the project's cost of equity. This ungear to re-gear maneuver, it is absolutely the examiner's favorite trap. They will test it over and over again. If you can calmly and confidently execute this flow while other students panic, you're going to rack up critical method marks and completely separate yourself from the pack.
All right, Section 4, International Investment Decisions.
Now that we've successfully appraised the local project and nailed down its core risk, it is time to take our massive corporate venture overseas. And oh boy, this introduces an entirely new layer of extreme complexity. When you're forecasting those foreign cash flows, you survive by visually separating two critical concepts. Try using this mental hook. Think P for prices when looking at purchasing power parity, or PPP. You use PPP to factor in inflation for long-term, multi-year forecasting of exchange rates. On the flip side, think I for immediate for interest rate parity, or IRP. You use IRP because interest rates drive forward rates for short-term, immediate hedging. You really need to know exactly which tool to pull from your toolbox depending on the time frame.
When dealing with overseas investments, cash doesn't just instantly magically appear in your bank account. The chronological path of your overseas cash requires some extreme attention to detail. So in year 1, you forecast the subsidiary cash flows in the local foreign currency. In year 2, you convert those flows to the parent company's currency using your PPP or IRP forecasts. But, and this is huge, pay close attention to year 3, blocked funds. Imagine your foreign subsidiary is printing money, making millions, but suddenly the local government freezes all foreign remittances. You literally cannot touch that cash. You have to step in and purposefully delay the cash inflow on your timeline until that restriction lifts, heavily discounting its value in the process. Finally, in year 4, you apply the parent company's tax rate and discount the whole shebang at the WACC.
Here is the golden rule. International NPV equals remitted cash flows to the parent after Forex and withholding tax. As the CFO of a multinational corporation, you frankly don't care how rich the foreign subsidiary looks on paper. Shareholder wealth just isn't generated by trapped capital. Your final NPV calculation should never be based on the cash merely sitting over there in a foreign bank account. It must be based entirely on the hard cash that actually makes it back across borders into the parent company's bank account, after surviving the brutal realities of exchange rate shifts and severe foreign withholding taxes.
And finally, Section 5, Final AFM Exam Strategy.
If you want to conquer this exam, you have to proactively spot the traps. Let's look at the WACC trap first. If you use WACC for your base APV calculation, you are mathematically double counting the tax shield. Why? Because WACC already includes the tax benefit of debt. Always use the ungeared cost of equity for the base calculation. Next up, when ungearing beta, do not forget to multiply the debt value by 1 minus the tax rate. It's a classic mistake. For the international NPV trap, like we just discussed, always use cash to the parent, not the subsidiary. And lastly, if a question mentions managerial flexibility, like the real option to delay, expand, or abandon a project, always state clearly that a traditional static NPV calculation significantly understates the true strategic value of the project.
State your assumptions clearly. Show all your workings, and link your calculations to strategic advice. Remember, numbers alone will not get you across the finish line in advanced financial management. The examiner isn't just looking for a human calculator, they are looking for a future financial leader. Even if your final mathematical output is slightly off because of some tiny error, showing all your structured workings clearly is going to earn you vital method marks. But most importantly, you absolutely have to bridge the gap between those complex spreadsheet numbers and strategic, real-world, actionable advice for the business.
So you now have the ultimate blueprint. You know how to strip down an adjusted present value, you know how to safely ungear a contaminated beta, and you know how to aggressively navigate the perilous waters of international cash flows. But here is the ultimate provocative question you have to ask yourself before sitting down on exam day. Are you just memorizing a sequence of formulas, or are you truly ready to step into the shoes of a chief financial officer, look past the numbers, and make the hard commercial decisions that actually drive a global business? Keep that focus sharp, and I'll see you next time.